I start on this Excel sheet. Let me record this. Oh my God, I almost forget. And by the way, I see some of you scribbling on the Zoom. All right, please do not scribble, do not annotate. Let me just change the instructions. All right, great. So anyway, this is on Facebook Live. You guys can also watch it. I'll be posting the replay. Okay, number one, imagine, right, you have 100 customers coming in the month of January. All right, and your customer acquisition cost, meaning to acquire per customer, you have to pay about $600. Okay, and this $600 is your customer acquisition cost. And let's say the subscription that you charge per customer is $100 per month. Okay, so just having this three things here, we can actually work out a few things. All right, so number one, we can work out in total, how much in the month of January are you paying to acquire your customers, right? Since you pay $600 to acquire your customer, all right, and you have 100 customers coming in, all right? So this will work out to a customer acquisition cost, a total a sum of $60,000. So how I got this was I take $600 times 100, right? So I get $60,000. So same here. Right, so this is a total subscription revenue that I get per month from this cohort in January. Okay, so this bunch of people from January, they give me about $10,000 per month. Okay, so in this entire world, right, I want to ask you guys, do you guys think that when customers join you, right, will they stick with you forever, or in a perfect world, there will always be people who churn, right? So type churn or no churn, all right, in the chat box below. Right, in the perfect world, in the real world, would there be churn or would there be no churn?
Jonathan, I think on our Telegram group, there are people that are still waiting for the host to start meeting. Oh, I know why. I think they joined the wrong one. Okay,
so you can copy the link and give them. Let me give you co-host. Yeah. Okay.
Okay, it's okay. I think that the link we.
All right. Yeah. So. Yeah, I have 113 of you. Come on, guys, just give us more energy, right? Churn or no churn? Type in the comment section below. All right, so we have 1% of. So yes, you guys are right? Every Clarence, Verinda, right, Koksoon. Yes, in the real world there's churn, right? And let's assume, right, we have a 1% churn. That means in the second month, let me show you guys something. Okay, I need to hide my video panel because it's affecting me. All right, okay, great. So let's assume a 1% churn, right? Meaning maybe in the first month you have 100 customers, right? So in month 2, you have 99, month 3, 98, 97, 96, 95, so on and so forth, right? So that's how I got 100 here, 99, 98, 97, so on and so forth, all right? And next, after I got a churn of after I assume a churn of 1%, right? There's another thing here, right? So basically, after knowing that 1% of my customers churn every single month, right? So what I can figure out is that basically on average, right, if I lose 1% of my customers on month 100, right, I'll lose away all my customers, right? In general, this is how you actually interpret this very, very simply, right, without complicating things. Okay, so that is how we got the number of months and average customer stay, right? So basically what we do is we take 100% divided by 1%. All right, so that's how we got 100 months here. All right, if you guys can get 100 months, just type yes. Just type yes. If you don't understand, just type no. I can actually understand this. I can re-explain this part. Okay, so you have 1% churn every month, so you will last 100 months. An average customer will roughly stay about 100 months. All right, so from there, right, we can actually assume that if an average customer stays for 100 months, okay, so the lifetime value of this customer will be, basically how much they pay per month, which is this $100 multiplied by 100 months. Okay, since an average customer will last for 100 months, so how do I find what's the lifetime value, right? So basically 100 times 100, right? $100 is the subscription revenue multiplied by the average number of months they'll stay with me. Okay, so that's how I get $10,000. Now, how do I then get this total lifetime value per cohort? All right, so basically the lifetime value of each customer, right, is $10,000. So what I'm going to do is I want to find out what is my entire cohort worth, all right? So basically what I do is I take $10,000, which is the lifetime value of each customer. I multiply it by the number of customers I get per cohort, right? So this will work out to be $1 million, all right? So how do I get 1 million? I take $10,000 multiplied by 100, okay? $10,000 multiplied by 100, that's how I got $1 million here. Okay, so far so good. If you guys can get it, just give me a thumbs up, right? You can use the Zoom emoticon to let me know. All right, so now, after knowing all these numbers, right, how can we then know what is our so-called profit and loss? Okay, so let's assume, right, this is only our customers in the cohort of January. All right, so basically, like what we say here, every month, right, my entire cohort will give me $10,000 in revenue for the first month, right? Because I have 100 customers, and let me recap again. So per customer, I will earn $100. Okay, per customer, I'll earn $100, and that is how I got 10K, right, for the first month. So 100 times 100, that's how I got $10,000. So let me just maybe write down here, right? Customer revenue, revenue per customer, yeah. Okay, so this is $100. All right, and next, right? So what happens is that I will actually incur an upfront cost of $60,000, right? How did I get $60,000? It's because you see here, my customer acquisition cost for each customer is actually $600, right? So if I have 100 customers coming in, I actually incur $60,000, right? So $600 times 100. So this is how I get $60,000. Okay, now, so you can see here, right, what I'm trying to do here is I'm trying to see, right, how long it will take for me to actually break even. All right, how long it will take for me to break even. So basically, right, you can see every month I'll actually lose customers. So in month 2, right, I will have 99 customers left. All right, and what is my revenue for month 2? Right, my revenue will not be 10,000 anymore. Right, why? Because I only have 99 customers now. So what I do is I take 99 times $100, right, which is my revenue per customer. Right, that's how I get $9,900. Right, so what I do here is basically, you see, I start with a loss of 60,000. Okay, I add $10,000, which is what I earn, and you know, at the end of the first month, I still make a loss of $50,000. Okay, and assuming that 99 customers stay, and I earn $9,900, right? So since I'm still at a loss of 50K, right? If I add in $9,900, right now my loss, right, for this bunch of customers in the cohort of January is $40,100. Right, so this will go on and on and on, and you can see here, right, by month 7, right, I will break even on this bunch of customers who join me in January, right? If you guys can understand this, just say, just type yes, all right? So it's very important for you guys to understand this, because later on, right, I'll be talking about more than one cohort, all right? I'll be talking about customers in February, March, April, May, June, July, August, all right? So if you guys can, it's very important that you guys understand this based on one cohort, all right? So, you know, this is actually the graph here, all right? So basically, right, you can see this black line is actually your profit line, right? So obviously, you know, the first 6 months I'll be losing money, but if my customers stay long enough with me, right, because I only have a churn rate of 1%, can you see that I will actually be profitable, right? Even though my customers are falling. So I want to show you guys one thing, right? If your churn is very high, okay, if your churn is, let's say 20%, can you see, right, no matter what I do, no matter what I do, I will never ever be profitable. Okay, look at this graph here, right? Can you see this is the break-even line? And the line, right, will never ever touch the $0 mark, right? Because no matter what you do, right, your customers are churning out too fast. So, you know, if you drag out a 40 month, 50 month, 60 month, right, no matter what, you'll make a loss of about $10,000. Okay, so so when I say, right, you know, let's say if I have a churn of 1%, right? So usually what people in the industry say that if I have a churn of 1%, right, on a unique economic basis, right, based on one cohort of customer, I can actually be profitable in the long run. Okay, so now I want to ask you guys, right, even if I am making a loss initially, right, but if I know that, you know, my lifetime value of my customer, right, is $10,000, right, and my initial upfront cost, right, is actually let me see. Sorry, let me repeat that again. So if the total lifetime value, right, of my cohort, right, is $1 million, and to acquire this customer, right, I only need to spend $60,000. All right. So if you are the CEO of a company, right, guys, even though you have to make a loss of 60K upfront, right, how many of you will actually want to bring in more customers? So let me give an example. If I 10x my spending and I bring more customers, right? So instead of 100 customers, I bring 1,000 customers, right? Can you see that I'll be making a huge loss at the start of $600,000, right? So if you are the CEO, right, how many of you will actually spend as much as you can, right? Type spend as much as you can or spend conservatively, right? Type in the comment section below. If you know that, the lifetime value of one customer is $10,000 and the cost to acquire each customer is $600, right? How many of you will spend as much as you can, or will you spend conservatively, right? Just type in the comment section below if you're the CEO of this company, right? I'll drink water and I'll see what you guys type. Okay, we have 146 of you, and I'm only having 5 responses. So just type in so that I will know, whether if you guys get the concept here. All right. If I have a lifetime value of 10K, and I know that if I acquire a customer, I need to pay 600 upfront, right? Will I spend as much as I can or spend conservatively, right? So I see Karin says depends. Wi-Fire X says spend wisely. Fabian says spend many. Jingwei says spend as much as possible. Susanna says spend conservatively. Joanne says spend as much as possible. All right. So guys, I want to tell you, right, in every CEO's mind, right, it's all about if they see these numbers, right, basically you can see the lifetime value of a customer is 10K, right? And they are so sure about the product, right? The churn rate is 1%. So can you see in the eyes of the CEO, right? This is the ROI, If I spend $600 now, and the lifetime value of my customer is $10,000 because he will stay on with me for 100 months. All right, I'll be making a return of 16.6 times, guys, right? So, so this is what all the CEOs are doing. They will spend as much as they can, right? Because why? They know that when they break even, they'll make big money, right? So let me just show you the difference, all right? If I have 100 customers here, okay, at the end of the day, I'll be earning about $271,000, right, in month 40, right? But because I am so confident that my churn is only going to be 1%, because I know that my product is good, I know there's product market fit, right? I know what my customer pain points are, and I dare to scale up, okay? And let's say even if I get 10,000 customers, right? Even though, can you see that the losses are incredibly scary? Let me, let me check if everything is correct. Then, so 6,000, 1,000. Okay, so basically there's an error here. So my number of customers should be 10,000. All right. Yeah. So everything's correct. Yeah. So you can see, right, if I'm so sure, right, by month 7, I'll be earning $793,000. All right. So basically, this is why so many CEOs of SaaS companies, they are spending so aggressively upfront, and this is why they are so that's why they are loss making. All right. So Aga, to actually answer your question, right, basically what I'm showing you here is the matrix that you'll be looking at. All right. So basically, we are talking about churn, right? We're talking about the lifetime value of a customer. Okay. So these are the matrix that I'll be looking at, because I want churn to be as low as possible. If my churn is high, can you see that, I may not be profitable. Let's say if I have a churn of 20%, right? No matter how much I spend, okay, I will never be able to break even. Okay, so Fabian, you asked, is it possible that some companies don't report churn? Yes, they may not, but most companies, if they want investors to hop on, they'll have to report this amount because it's important. Okay, so I guess most of you do understand it. And Shao, to understand, to answer you, how do you ask, how do you get this data? Basically, this is just a fictional example to explain why SaaS companies are actually loss-making, and why do they actually dare to spend so much upfront? All right, because they actually have low churn rates, and also they are confident because with low churn rates, the lifetime value of their customers will be very high. All right, so a few concepts here. Let me just recap before going on to the next part, which I will combine all the different cohorts together. All right, so the main point here is we want to buy into companies with low churn, right? Because with a low churn, a customer will stay longer, right? So in this case, if every month I have 1% churn, all right, so an average customer will actually stay on for 100 months, right? And because every customer stays for 100 months, the lifetime value of my customer will actually be $10,000, right? So even if I spend $600 upfront, okay, it is peanuts to me because I know I will make back the money, right, in 6 months, okay? So you can see here, this is the number of months to break even, right? So how you calculate this? Basically, you take 600 divided by 100, right? And it makes sense, right? Because a customer pays about $100 per month, and you know, the cost to acquire them is 600. So within 6 months, you'll break even. Okay, so this how so this is what I mean, right? It is so important for each cohort, right? So I want to emphasize this again. We are looking only at customers who are coming in the month of January, right? Just one cohort, all right? And basically, you know, if one cohort is profitable, then most CEOs will actually ramp up the spending. So now I'm going to show you guys, right? If I do not have just one cohort, if I have many cohorts in the picture, right? How would the profit and loss look like for a company? All right, so this is how it will look like roughly. Okay, so before I go on, I want to answer some questions. So Celine asked, most SaaS companies' churn rate is 1%. The answer is no. Every SaaS company have different churn rates. All right, and so Susanna asked, I don't understand how spending more money earn more. Susanna, basically when you spend more money, because okay, the lifetime value of each customer is 10,000, and you're only spending 600 to acquire them. So over time, slowly and surely, you will make money, right? Because your returns is very high. Because you just take $10,000 divided by the cost to acquire them, right? And that's 16 times. So for every $1 you spend to acquire customers, you make 16 times. All right. So this is how we actually understand this. But if your churn is high, then can you see your return on investment will be very, very low, and that is why you never ever break even. Okay. So basically, this is how you can actually look at this. Okay. I will just move on. So now, what I'm showing here, guys, right, is basically what if I have a company that has more than one cohort, all right, not just January, right? So previously I was just showing you one cohort here, right? And you know, first month 100 customers, second month after 1% churn 99, 98, 97, 96, 95, so on and so forth, right? So now, right, you see, in January I have 100 customers, and in the second month, which is February, right, I have 99 customers left from the first cohort in the cohort of January, right? However, I have a new cohort coming up, right, which is the cohort in February. And this new cohort has 100 new customers. And in March, right, my cohort in January now have 98 people, right, because I churned 2 times, right? I churned 1% of 2 times for over 2 months. And my cohort in February, right, churned 1 time, right, because only 1 month has passed. And from 100 customers now, I have 99 customers. And now I have a new cohort in March, right? So I start with, so I have new customers, and these new customers, it will be 100 people. All right, so you can see when you have, in a real business, this happens, right? It's not just looking at one cohort. We have many cohorts coming in every single month, right? And we want to calculate what is the total customers coming in. And from there, right, you can see every single month, because I have a new cohort, right, I will spend $60,000. All right, so let me repeat that. Every month, right, I have a new cohort coming in. So I need to keep paying my customer acquisition cost of $60,000. Right, so how do I calculate this total revenue per month? All right, so what I do is I take the total customers multiplied by the subscription per customer per month, which is 100. All right, so you can see month 1, I have 100 customers, right? So that's how I got. Let me zoom in. Maybe it's a bit small. Okay, excuse me. All right, so let's say in month 1, right, I have 100 customers. Okay, and how do I have this $10,000 figure here? So I take 100 customers times $100 per customer, right? So it's the subscription revenue per customer. So that's how I get 10K. Okay, month 2, what I do here is I actually have 199 customers, right? So how do I get 199? You know, because in the cohort of January, now I have 99 customers, right? Because of 1% churn, and on top of that, I have new customers coming in, right? A total of 100 new customers coming in. So in total, I have 199 customers coming in here. right? And how do I get 19,900? I actually take 199 customers multiplied by 100. That's how I get 19,900, right? So how do I calculate, all these profits here? So basically, right, the first year, because you acquire your customers for the cohort of January, right? So you spend $60,000 here, right? So after you incur the 60,000 cost, all right, you get your subscription of $10,000 from your customers in your first cohort, right? Cohort of January. So that's how you get. You still end up with a loss of a negative $50,000. All right. So now, in the second year, right, you incur $60,000 cost again because you're acquiring new customers, right? And this time is a cohort of February. All right. So what we do is we actually bring this loss over the second month and we incur additional loss again. So that's $110,000, right? And in the second month, right, I actually earned $19,900 in revenue, right? So if you take minus 110,000 plus these revenues that's coming in, so my net profit, right, considering the effects of the cohort of January and February, the first 2 months, right, will be $90,100, right? So I'll be making a loss of $90,100. So this keeps repeating on and on and on and on and on, and eventually, right, a company will actually hit a break-even point, right? The company will actually hit a break-even point. So before I go on and share more insights, I'll be looking at the questions because I see lots of questions coming in. So can I request the audience to just mute yourself? So, yeah. All right, so now, Simple Investing asks, I wonder if the theory of reflexivity will affect when everyone adopts the same attitude, which is to spend as much as possible in order to capture markets, when in turn draws in more competitors, Grab and Uber, and cause initial data to be inaccurate, overestimate. So Simple Investing, actually what's happening is a lot of these companies who are SaaS actually are practicing this, right? Because they already have data that based on a unit economic basis, each cohort is actually making money. That is why they dare to actually spend more, right? They are actually very data driven. So Susanna asks, if the cost is $700, then it takes 7 months to break even, isn't it? Susanna, so going back to this first example, the cost is actually $600. So it takes 6 months to break even. Okay, David asks, which metric is the part on annual recurring revenue? I don't really understand your question. Could you just maybe rephrase it so I can understand better? So Agra says, will we be able to get this Excel file? Sorry, Agra, but this doesn't belong to me. So I just want to respect the creator. So Daniel asks, do SaaS companies with such low churn rates have sustainable mode, high switching costs long-term when more competitors or big tech enter the scene? Daniel, I'll be showing you an example later, a real-life example. Winston asks, churn rate seems to suggest that there's an outflow and inflow rate, but what you are using to describe seems to be suggesting that there is an attrition rate. Is this correct? So churn basically means an outflow of customers. Churn is always about outflow of customers, not about inflow. So the churn here I'm referring to is a churn of customers. So Sam says some SaaS companies operate the idea of being acquired in mind. Yes, some of them do, but most of them have very rich valuations. So I think it's pretty expensive to acquire them. So Hui says spending more money to acquire customers doesn't mean you can get them, nor hold them forever. So Hui, you're absolutely right. And that is why it's so important for us to monitor the churn rates of SaaS companies. Okay, so basically, Simple Investing asks, how about the cost of keeping a low churn rate, such as keeping your margins as low as possible, such that no other competitors are coming in? Simple Investing, I'll be sharing with you a real-life example later, which is CrowdStrike. So they're able to lower their margins, increase their margins, and also they are actually able to compete as well, because some of these SaaS companies are in industries that are growing, they're in a growing pie. So even though they're competitors, right, but because the pie is growing as well. All right. So by the way, are there any questions relating to this Excel calculator? Because I want to address questions related to this calculator rather than other questions. So Mahika asked, what about variable costs incurred for retaining customers? Right. So yes, this is a valid point, but Mahika, I just want to keep it as simple as possible, because if you have too many variables on an Excel sheet, it's very hard to drive across a point, right? But what you do have is a very good point. But in fact, actually, the cost incurred for retaining customers is actually very low, right? If you actually read some of these research papers, usually the cost, right, to the highest cost is always acquiring customers, right? Because when customers come onto your platform, right, it's easier to upsell them, and most of the time they buy more products, right? So eventually, in fact, sometimes when customers come on board, they actually pay more, right? And they actually don't really have, in a sense, a cost related to, in a sense, maintain them. Of course, you know, you still have your data server cost, but that's actually very minute. Yeah. So Shah asked, what's the main message? So Shah, I'm coming to the point really, right? But I just want to make sure that everyone understands this. So just be patient with me. One last question, right? SRT says, a question, the cell in each column is the revenue per month. Do you assume all customers join at the start of January? So SRT, basically, to answer you, right, I'm not assuming that all customers join at the start of January. That is why I'm showing you different cohorts here, right? So this row here shows people joining in January. This row here shows people joining in February, right? So that's why you can see they start in month 2, right? This row shows people starting in March, right? So that's month 3, okay? So SRT, I just want to make it easy. Yes, they start at the start of each month, right? So yes, this is a very simple assumption. Otherwise, there's no there's no end to how we're going to calculate stuff. All right. So now I think I've answered everyone. So guys, can you see, right? Okay. So number one, I've shown you guys, right? If I have a churn rate, if all the numbers stays the same, right? Can you see this is a customer acquisition cost of $600, and per customer they're paying $100 per month, right? So if the churn is 20%, right? Can you see, based on the unit economic basis, right? Unit economic basis, let me repeat again. It means how is each cohort even able to hit profitability, right? So if we have a churn of 20%, we will never ever hit profitability on each cohort. Okay, and that is why, right, I'll show you guys, if I am a real company and I don't have just customers coming in the month of January, right? If I have customers coming in February, March, April, May, and I have a terrible churn rate of 20%, can you see, right, the more I spend, so basically this graph shows you the profitability of the company, right? Can you see, the more I spend, the more I acquire customers, right, the more money I'll lose, right? No matter what, I'll never hit profitability, right? So I want to share with you another thing here, which is we are assuming that on the 10th month, right, which is in the month of, let me check, okay, in the month of October, okay, we are not acquiring any customers beyond the 10th month. So you can see here, right, I'll have a huge spike in losses, right? So can you imagine, right, if a company is not even profitable on a unit economic basis because of high churn rates, right? Can you see that they will never ever be profitable in their life forever and ever, right? So this is very scary. If you have a SaaS company that have a really huge churn rate, right, then you know, it is time to say goodbye, right? I will definitely be jumping out of this SaaS company if the churn rate was so high. All right, but let me show you, right, ideal scenario, right? If the churn rate is very low, churn rate of 1%. Okay, I want to show you guys something, right? So can you see, right, we will actually experience a period here of huge losses at the start. The loss will keep mounting, and after that the loss will actually slowly come down, and when I hit this tipping point, right, this is where my profit will shoot through the roof, right? This is what I call the tipping point. All right, so this part is actually the tipping point. All right, so there will always be this period of trial. Right, later I'll be showing you guys some real life example of a company, right? So I want you guys to understand the theory. So when I show you guys the real life example, you'll become much more understandable, right? And let's take a look at the numbers, right? Where is the tipping point, right? The tipping point is actually month 11. All right, so I'm gonna share with you, right, what is this colors here, right? These colors represent whether if this cohort, right, whether if it's profitable at the certain month, right? So let me just explain, right? So basically you can see here, right, all my numbers here are the same, right? And basically my numbers here are the same as this, right? So if I have a company with a 1% churn rate, can you see that by month 7, right, I will actually be profitable already. The cohort will be profitable. All right. So you can see here, all these numbers are the same, right? My customer acquisition cost is the same, subscription per customer per month is the same, churn rate is the same. All right. So you can see here, for the batch, for the cohort of January, I am actually profitable on the 7th month, right? And this makes sense, right? Because why? Take a look at this, right? This is what we have been discussing just now, right? On the 7th month, I'll be profitable, right? It takes me 6 months to break even, and on the 7th month, I'll finally be profitable. Okay, so let us see, right? On month 11, right, how many of our cohorts are actually profitable, right? So you can see here, on month 11, right, our cohort of January, all right, of February, March, April, okay, May, okay, will be profitable, right? And this is almost half of the cohorts in all the cohorts I have, right? So this is 1, 2, 3, 4, 5. 5 cohorts out of 1, 2, 3, 4, 5, right? So 5 cohorts out of 10 cohorts are actually profitable already. So why is the cohort in June not profitable? Why? Because they are only how many months in, right? So 1, 2, 3, 4, 5, 6, right? They're only 6 months in, and only on the next month they'll be profitable, right? So same goes for July, August, September, October, right? So they'll be profitable on this month, right? So you can see that is what I call the tipping point. So every SaaS company will actually have this tipping point, right? So once they actually have more cohorts profitable than existing cohorts that are coming in that are not profitable, that is where they'll start becoming profitable, and they'll be tremendously profitable, right? Because, for example, you can see, let's say in the cohort, for the cohort of January, right, on the 7th month onwards, right, all these revenues that are coming in are, in a sense, what we call free profits, right? These are revenues that come in and recur, and the cost has already been paid for, right, in the first 6 months. All right, so this is what I call the tipping point. And let me explain to you guys why so many of these SaaS companies, right, they are so highly loss-making at the start. Because most CEOs, right, if they see this kind of thing, right, if they see that, the customer acquisition cost is $60,000, but the lifetime value is $1 million, what they'll do is they'll actually ramp up. So I want you guys to actually focus on the losses here, right? So my highest loss, right, can you see here, is around month 7, right, where I will suffer a loss of $145,000, right? And when I break even, right, so help me just remember these two numbers, okay? $145,000 in loss, and also on month 47, I'll make about close to $3 million, right? But what if I know that, I will definitely make money, and, my costs will become profitable, and I want to 10x and scale my business, all right? So instead of having 100 customers coming in per month, I have 1,000 customers coming in every single month, right? So can you see, initially, right, the trial here, right, even though the shape here didn't look bigger, but can you see, I'll actually incur higher losses. And this can look very, very scary, right? But it will actually pay off, because on month 11, right, when I become profitable, can you see the money will just gush through the roof, all right, because of my existing customers who are already here. And can you see, on the last month, right, instead of having profits of about maybe $3 million, I'll have a profit of $29 million, right? So this is why so many of these SaaS companies, right, with low churn rates, with CEOs who are very confident about our products, they have already gone through a year or two in business, and they know that, their churn rate is about 1 to 2%. That is where they dare to scale from 100 customers, okay, 100 customers, right, where they maybe make a small loss, okay, then after that, maybe in month 11, they make a profit. Then they say, wow, actually this works, we have a low churn rate. So why not, let's go and raise money, right? Let's raise $10 million, $20 million, or billions of dollars, and acquire as many customers as I can, right? It's okay if I lose money, right? If I burn $6 million every single month, it's fine, right? Because I know these investments will pay off because I have a low churn rate, right? So this is what's happening to most of these SaaS companies, and this is why they are loss making. Okay, so you guys can hear, right? I'm super passionate about sharing this, and I hope you guys can understand, why so many of these SaaS companies are loss making, and why is the stock price going up so much, right? Because investors are actually forward looking, right? They are investors, right? Like us, right? Investors, we don't care about here. I mean, we do care, right? Because during here, right, we have to observe that our churn rate must be low, right? So once the churn, right, can be maintained at low rates, right? So where investors like us, right, let me just scroll up, right? Where investors like us will actually really benefit, right, is the top part here, right? We'll make insane amount of money when we actually, hit the tipping point, right? Where there are more profitable cohorts, more than the loss-making cohorts. All right, so I hope this is clearer to most of you guys for those who are actually not in the SaaS industry. All right, so I'm going to answer maybe about 8 questions before I go on to show you guys a real life example, right, of this playing out. Because I'm a believer of being practical, right? I don't like to show fake examples, fake numbers. I mean, these are all fake numbers, but I'm going to show you this happening in real life. All right, so we asked, is there a replay for this session? Yes, there's a replay. Why fire act? Can you simulate acquisition cost 500, lifetime value 1,000? How long does it take to break even? So lifetime value of $1,000, basically, okay, this one later we can simulate, right? Because I want to share this thing that's happening in real life, right? SRT says, hi Jim, question on acquisition cost, was it covered? How was this computed / referred? So customer acquisition cost is something that is the cost of sales and marketing. So you can actually find this on the annual report. So these numbers here are actually plucked out from the sky. It's mainly for example's sake. All right. So basically, there's no formula on how this is recorded. I just want to show you guys, why companies are loss making. Because why SaaS companies are loss making? Because they incur a high upfront cost and they will charge a lower subscription revenue, and they will only make back their money as the customers subscribe. All right, so Susanna asks, how do we find the churn rate of the SaaS companies? I'll show you later. SRT says, do average contract duration matter here? SRT, average contract duration, yes, it does matter. It tells us how sticky and how long the customers will lock in. So it gives us confidence how long a customer will stay with the company. All right, maybe 3 more questions. So Cohort says, spending money at the start to acquire future almost steady profits. Yes, absolutely, you got this. You got the concept right. Okay, so David asks, is there a website where you calculate churn rate, or we have to research and calculate ourselves? David, you have to research this. I do know of a website, later I'll be sharing, right? So Tak, could you just remind me in case I forget, right? So one thing here, share with them the website on how they can actually get information on SaaS companies. Okay, thanks, bro. Sorry, because so many questions coming. Are these companies sustainable with so many competitors? Definitely, we can show you some companies that are dominating it. Charles asks, assuming there's a SaaS company which initially has low churn rate, would it be good to enter and invest in it while loss-making or only when proven profitable? So Charles, after knowing this, right, you really want to invest when they're loss-making, right? Because you will know that they'll be profitable one day. So you really you have to monitor it, right? So because by the time it breaks even, then it's kind of too late. David asks, what is the benchmark for SaaS companies which are doing well? So David, my benchmark is I want it to be lesser than 5% churn. Okay, Tan HJ say, understand with so rich valuation, not sure if growth are sustainable, revenue growth post-COVID and earnings growth with more competition. So Tan HJ, that's where you have to understand the qualitative aspect, right? Even though they're competitors, right, but is the pie growing, right? If the pie is growing, then, you have to, then it's okay, all right? So you have to know someone who is in the industry. Yeah, so this is what I usually do. All right, so David Lambono from Facebook, you say, well explained, bro, love the recurring revenue business model. So you wanted to ask, you want to add some points. Big spending in the early growth stage may be a wise move, especially if the company is an early adopter and is ahead of its competitors. Okay, I think these are just comments made by you. Fantastic. I think, these are actually fantastic comments left by you, David. Really love your comments there. All right, so okay, now let me show you guys some companies that not some companies, we are limited by time. Basically, one company where this thing is actually happening. All right, so now I'm going to show you guys something, right? I know you guys probably know that I'm actually a investor of Crouch, right? And huge disclaimer here, not a recommendation buy or sell, and obviously I'm an investor and therefore I'm biased, right? So don't take everything I say for real. All right, these are just my opinions. Not a professional analyst or whatever, not, right? So I'm just here because I want to share with you guys. Okay, so what I do is I actually look at the investor presentations, right? So for those who have been asking, can companies maintain their churn rates for a long period of time? Definitely yes, all right. So take a look at this, right? So CrowdStrike is a company, okay, which has operated from 2018. Oh, okay. So Jingwei says can consider turn off Facebook. Okay, I didn't know this is actually the sound. Okay, is it better? So I hope it's better now. So pardon me. Okay, I think it didn't. Okay, so now let's take a look, right? So basically, you can see CrowdStrike, right? It has um, uh, this is the gross retention of CrowdStrike, and basically what happens is we are seeing that they're actually retaining their customers at a rate of 94% in Q1 2018, Q2 2018 94, 96, 96, 97, right? So obviously, right, if they are retaining 94% of their customers, that means the churn is 6%, right? So when I look at a company that is increasing their retention rates, right, it means that churn is coming down, right? So in fact, CrowdStrike is a company that's, let me show you guys the latest revenues. Okay, CrowdStrike is growing at a rate of their subscription customers, the number of customers is growing at 91%. Revenues are growing about 80+%. Let me show you where the revenues part is. Yeah. So compared to Q2 2021, you can see compared to Q2 2021 and Q2 2020, revenues actually grew by 87%. All right. So it's growing at 81%, and the churn rate is actually coming down. So this is a company that which is very impressive, right? Because you see competitors coming in. Okay, you see competitors coming in, but they're still able to lower their churn rates. All right, so this is something which I think is a very good sign. This is what I look out for. All right, and next, I wanted to share with you guys, right? You guys see this phenomenon here where I share, the companies actually heading to profitability. Okay, so you can see here, let me show you guys. Right, so you can see here in 2017, 2018, 2019, 2020, this is actually the white color thing here. Okay, the white color chart here actually represents your sales and marketing costs. The gray color chart is your R&D costs, right? Then your red color here is actually your general and administrative costs. Right, so general and administrative costs is basically your cost to actually pay for your rent, pay for admin costs will be something like paying for your employees, right? So you can see that the cost is actually coming down, right? Because more and more of their existing customers, the cohorts are actually breaking even, right? And in fact, not just that, right? Existing customers are actually buying more and more, right? So and let's say, right, how you actually look at this is, for example, if the net retention rate, right, this red line here is 124%, it means that if I have a customer that spent $100 the previous quarter, right now they're actually spending $124. So they're even spending more money, right? So not only you're preventing churn, right, you're decreasing churn, but existing customers are actually paying more money to you, right? Because they're taking up more of your modules. Right? So this is something that's that's actually driving up the profitability, right? So that's why you can see in Q2 2021, the CFO actually, the CEO actually guided that they might see themselves becoming profitable in the next quarter, right? So this is a company that I've been I've been following, and I'm really very impressed with the management ability to execute. Right, so you have lots and lots of cybersecurity players coming into the industry, right? But I personally feel that the fact that your company can actually lower churn rate, okay, they can lower churn rate, and they can maintain a very, very low churn. It shows something, right, that they are so good in retaining their customers, right? And also, I think some people, they discount how sticky solutions can be, right? Because imagine if you change the software, you have to retrain all your employees, you have to retrain everyone in the company to learn how to use the software, right? Then, I just want to ask you guys, right, if you are an MNC, you have about 1,000 employees, right? Is it easy or hard to retrain people? Yes or no? Just type in the comment section below. Right? I just want you guys to I just want to have a consensus from the crowd, right? So is it, if you change your software, right? It can be a cybersecurity software, it can be HR software, right? Is it easy or hard to retrain your staff, right? Yes or no? Is it easy or hard? Okay, yes, especially, right, you have to retrain them, And sometimes it's so hard to convince employees to actually come on to the platform, right? So don't discount that, guys. Every time people talk about competitors and everything, right? But let's be how I do this is I would like to be data focused, data driven, right? If their revenues are still growing, they know they're actually growing in a huge pie, right? More and more companies are moving to the cloud, right? So yeah, this is really the end of almost the end of my presentation. And if more of you want to, actually explore some resources that I have, I actually have a Telegram group. You can actually take down this, have a screenshot, take a photo and screenshot, use your phone, use your camera and take a photo. All right, so I actually share my tips on companies I'm looking at. I actually share about CrowdStrike every time there's a quarterly earnings. I actually do an update. I also have my founder, Kelvin Sito, right, who actually basically shares lots of great stuff there, right? I also have a YouTube channel where I share really, I think if you guys take a look at YouTube channel, you understand what I mean, right? I really don't hold back on my research, and you guys can see the way I research on SaaS companies, right? If you guys want to talk to me, you can follow me on Instagram, drop me a DM, right? Pardon me if I reply slowly because sometimes I have lots of DM. I may take 2 to 4 days to actually reply. Right. So if you guys have actually enjoyed this sharing, all right, let me know how you felt about this content sharing so that at least I know how I can improve. Let me know your comments below, how you felt about this session. And the next time T.U.B invites me up, right, I can actually fine tune my company better, my research better, so that you guys can actually enjoy and benefit from this, right? So back to you, T.U.B. I'm done sharing.
Okay, thanks, Jonathan. Okay, now we still have 165 participants in this group. So thanks everyone for joining. Thanks Jonathan for the very, I would say a very good sharing on why SaaS company is loss making at the start. Just one problem probably is that it's too number driven and it's quite late at night right now. So I just wondering if everybody will understand what is being shared. But anyway, don't worry, it's recorded. You all can take your time to understand later. The main gist I think of what he's trying to share is that companies that's doing SaaS, SaaS business, they are loss making. They could be loss making. If you look at him, he shared as monthly, first month, second month, third month. If you imagine it to be years, first year, second year, third year, this could happen as well. And you can see that the cumulative profit kind of share graph that he shared just now, right? It can look a bit like what is the share price, for example. Maybe the first 3 to 4 years is really not moving up, and then suddenly you see the share price going up. So anyway, thank you Jonathan for the sharing.